This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Alrighty, thank you all very much for taking the time to watch this video. It's been a while since we did our last update, so hope everybody's summer is going well. The weather's cooperating a bit for us, which should be good.
Slowly starting to turn.
Yeah, which is nice. So we're gonna try and keep this really short, concise. Try not to take up too much of your time and get you guys away from the sun. But just as always, gonna start with a market and economic update by Ken. And then afterwards, as always, I'm going to go through the mandates, a little bit of the performance, kind of talk about what kind of shifts have been in terms of our strategy. And you know what we're thinking of as we navigate kind of through not uncharted territories, but through a lot of noise in the market as it stands right now. So without further ado, Ken, I'll pass it off to you and go through what you need.
Yeah, I think that navigating through is the key, but there's a lot of things that we're navigating through, from the bearish sentiment to Mr. Jeremy Powell, to the volatility. There is certainly a tough time navigating because the so-called experts definitely seem to have a continued bearish tone to their sentiment. So we tried to get across the message at our Tom Dean's event on April the 20th. I spoke very briefly for 20 minutes, and what I wanted to get across was that the consensus view is usually always wrong. And yet again, it definitely appears that the bears are in big, big trouble so far this year on their very bearish calls. So if we take a look at the returns so far, and 6 months doesn't make a whole year, but certainly if you miss this run, it would be very, very painful. And we're happy to say with our very decisive asset allocation model, we didn't miss this run. So if you take a look, as of today, the S&P 500 closed at 4,380 so far this year. It's had a great run. It's up almost 14% as of today. Certainly, you take a look at the NASDAQ. We'll talk about that in a few minutes on the big 7, the big 8 mega cap stocks. But what an astounding rebound, up 29%. But I think if you look at this chart, there's a lot of stories to tell within this chart. Maybe you just click back one so we can actually look at the numbers there. Yeah. So if you take a look, and don't forget what was clearly said in the beginning of the year. As we were in a bear market, all these so-called experts were saying you never enter into a new bull market with the same leadership of the previous bull market.
Yeah.
That did not happen. Tech led into a very long bull market, and now tech has led us out of this one. But of course, the bears are saying
there has to be new leadership.
There has to be new leadership, but there hasn't. So now that the bears are totally wrong, what are they saying? Oh, it's all because of AI. And
the bubble surrounding AI.
Yeah, and everything's overbought, and there's still trouble on the horizon. We don't buy that. So when you take a look at the S&P TSX, up virtually less than 2%. Well, what was the euphoria going into this year, 2023? Well, due to supply chain issues, due to the geopolitical risks, commodities are going to still be the place to be.
The commodity super cycle is what everybody was touting.
And
right?
did that happen?
Well,
It
definitely not yet. We've
it
seen
definitely hasn't happened. Yeah. I mean, gold is under attack. Oil is down $2 a barrel today. Yeah. And so when we take a look at the Canadian marketplace comprised of energy, commodities, and banks, banks have been a tough place to be as of late, especially with the regional space, in the U.S. So you take a look at the Dow. There's another classic case. Well, those were the so-called value stocks that were supposed to lead the way in 2023. And it didn't happen. Yeah, clearly didn't happen. And then you take a look at the MSCI, the EFA, very, very solid returns for the first half of the year. And since 1945, almost 50% of the time you have a positive first 6 months, you get a very positive second half. Yeah, so good. Again, what did we hear in late April, early May? The classic. Sell in May and go away. Okay? And the experts were saying, don't wait till May, sell in April. Well, the market since May the 1st, the S&P 500, is up over 200 points or 5%. So sell in May and go away certainly didn't work in 2023. And a lot of this pent-up pessimism is continued to surround good old Jeremy Powell. And Mr. Powell has come out and clearly said, yes, we paused because of the pressure on the regional banks. However, we see 2 more rate hikes in the cards this year. Do you believe him? Well, Mr. Powell told you unequivocally dozens of times that inflation was only transitory.
Just transitory.
Transitory, transitory, transitory. He finally retracted that statement. And he said, and I'll paraphrase him, he said, I need to remove the word transitory from my vocabulary. But let's take a look at some of another key projection that he got dead wrong and why you might not want to believe his words as of last week. Well, the beginning of 2022, with the Fed fund rate at 80 basis points, he predicted that the Fed fund rate at the end of 2022 would be 85 basis points. Well, let me tell you, it closed out the year at 4.3%. He was only wrong by over 6,000%. And you want to believe him now. Now we have the Fed fund rate at 5.08. Okay? So he continues to be dead wrong. And that's why we always take the contrarian view. And especially if you go to you can flip that next chart, and that just shows the progression of the markets that we've talked about. But the next one is the big earnings surprise. We told you in our newsletter that we thought that earnings were going to be better than anticipated. And sure enough, they were. I mean, you take a look that, 70, almost 80% of companies beat their earnings estimate in the first quarter.
It's huge.
Huge. Yeah. Well up. That surpassed the long-term average of 66%. So it was supposed to be a profit recession. That's what the bears told you. Okay? But the profit recession never happened. So if you're a bear and you're wrong, you want to continue to be bearish, so what do you say? Well, unemployment is going to eventually get affected, which it hasn't. We're at the lowest levels of unemployment on both sides of the border in 4 decades.
Mm-hmm.
So that hasn't happened.
Weakening a little bit, but still there.
Weakening ever so slightly, but the consumer has been resilient.
Yep.
Wage growth has been very strong. Mm-hmm. So when's this thing going to roll over?
Yeah,
well,
people are searching for, the bears are searching for something, right? And I'm gonna
they
touch on
keep
that.
searching, and they keep extending the time frame. So now they're talking about going in to, it's not going to happen until 2024 now. Well, you missed that almost 15% rally on the S&P 500, and you miss. That's a hard thing to play catch up after the devastating year in 2022.
Yeah.
So as we were working diligently when the market hit the low in October of 2022, we were putting more risk on the table for our clients when everybody else was extremely bearish. We continued that trend going into early 2023, and it's absolutely played dividends. Great, strong returns for our clients relative to what the rest of the playing field looks like. But if you look at the story, and the bears are saying, oh, wow, this is all about AI. Look at the returns of some of these stocks, the Microsofts of the world, the Netflix of the world, the Amazons of the world, Microsoft. All of those stocks are in our U.S. focused growth mandate.
Four of the eight
are in our U.S. focused growth mandate, which is up approximately 25% year to date. But the story of the bears is that, this is all about AI. Okay.
It's overhyped.
And it's too much, too soon, and the market is oversold in this area. Well, the S&P 500 and the NASDAQ have been up prior to this week 5 straight weeks in a row. So we get 3 down days, and now the bears are dancing in the streets saying, see, the rally's over, rally's over, this thing's done. Well, what happened today? Mm-hmm. What led the way?
NASDAQ again.
Tech stocks led the way solidly through. So what separates our view from the consensus view on the street? The consensus view is that these stocks are ahead of themselves. They're not worthy of the multiples that they're trading at. We don't believe that, because when there was a banking crisis, where did investors flock to? They flocked to companies that have enormous cash flow, that have enormously strong balance sheet
and growth potential.
Yeah. So they got it wrong there again. But our view is this, is that we believe that the market, if it's going through a pause, that's a good thing. We've had a good run.
Take a breather for a second.
Take a breather.
Yeah.
But we believe that these tech sector will continue to lead the way. Where we differ is that we believe the broader market and other sectors within the economy will play catch up to the returns, maybe not as high as what we see in tech, but we believe that the narrow participation that you see in the marketplace today is going to broaden over the course of the year.
Yep.
And that's where we believe, because strong employment still, wage growth, consumer spending.
And you've started to see that play out a little bit, especially in the small cap space, which everybody tends to say, okay, well, if we look back historically and say, what has usually led us out of a recessionary environment or led us out of the bottom of a market?
Yeah.
You take a look back at history, it's been the small caps.
Yeah.
Right? It's been those kind of smaller capitalization companies that inevitably got hit hard and make the full-fledged jump upwards afterwards, right?
Yeah.
So that didn't happen because the large caps led the way out. But what we're starting to see, especially over the last month, and specifically in our very small to mid-cap strategies, there's been a little bit more breadth to the market as a whole.
Absolutely.
Right? And so I think you are correct. We're going to see a little bit more of that continue, I think, throughout the year. And if we get a pause on some of these names, that's a good thing, like you said, at the end of the day.
Yeah, they're not going straight up.
They're not going straight up. But people always tend to forget what happened 6 months ago. We had Google down 40% in the middle of the calendar year.
Yeah.
Okay, so it's up 40 now. One of the largest companies in the United States of America. We had Microsoft touting that level. We had Amazon also there. These companies got really negative.
Yeah.
And people tend to forget that. So they're surprised that they're rebounding. Yeah, because they're solid companies with solid earnings moving forward. Yeah. So it's just the view on the street that what inevitably was the last 10 years of a bull market can't lead you out into the next. And you know what? I think it just speaks to our society. Everything's becoming more technologically advanced.
Absolutely.
We're more ingrained with technology. And sorry, I just don't know if the commodities, like it was in the Industrial Revolution, all that stuff is going to lead us into the next big thing moving forward for our society.
Yeah, and how are the Canadian banks going to lead us out of this?
Yeah.
Just don't see it. But, everyone seems to be playing catch up. Like Bank of America, they weren't as bullish as JP Morgan going into 2023. However, on May 22nd, Bank of America, which had a year-end 2023 target of 4,000 for the S&P 500, increased their target on May 22nd to 4,300. Well, we're just shy of 4,400. Yeah. What are they? What are they going to do now? Yeah. Roll it over again? And when? The last thing I'll say before I turn it over to you is, I've been at this for a long time. 6 months isn't necessarily a trend, but it's looking, in our view, a lot more optimistic than what most people see. I think it's going to be a very accomplished year, and we'll just see how it plays out. But I think we got you covered on this one.
Great.
I'll turn it over to you.
Okay, awesome. So next, going to give you guys the classic mandate review. I'm not going to spend too much time on the actual numbers because we are nearing quarter end here. All the fact sheets, all of our wealth notes are going to be disseminated shortly. So you guys will have all the numbers in front of you. But I really just kind of wanted to harp in and kind of talk more about what Ken was saying is a lot of the street and a lot of the bears out there are really looking for some sort of event to transpire to get us to what has been that recessionary call, right?
Misery demands company. They're looking for it.
And everybody, I guess, over the last kind of 2 recessions, major ones that we had, it's usually been started by a credit event, right?
Yep.
So they're looking for some sort of cracks that are inevitably going to create, I would say, contagion elsewhere and bring kind of the whole lot down like we saw in 2008, right? So specifically, and it's a little bit different in terms of which geography you're in because there are different, obviously, central bank policies, but everybody's pretty much in the same lines. But if we take a look specifically, and I'll start with just, we always have to kind of start with where rates are, right? Fixed income in the bond market usually leads the way for equities, right? Yep. So we have to understand what the credit environment we're faced with, right? And so the bears are saying that, okay, there's a credit event happening, and you know what? It's going to put pressure on consumers. The Fed has now took the terminal rate to up by 525 basis points practically, and the debt from a credit card standpoint's at $1 trillion, student loans are at $1.3 trillion. And so they're saying something inevitably has to crack because the consumer, as everybody well knows in the United States, is 70% of gross domestic product. Yeah. Huge, right? But what most people don't see, and they always talk about credit card debt, people racking it up on their credit cards. But the biggest component, if you're looking at the strength of the American consumer, right? Yeah. You got to take a look. If you're looking for a credit event, you look at their balance sheet. And so if credit card debt is at $1 trillion, student loans are at 1.3, and we haven't really seen anything happen in that space, people forget that those are actually minuscule on a consumer's balance sheet compared to the $12 trillion of mortgage debt. 10 times the level of student debt and credit cards. But the thing that's different about the United States compared to Canada is the ability for Americans to refinance, right? And so 60% of American households have a mortgage payment that is under 5% at this point in time. They had the ability to lock in their rates during 2020, 2021 at extremely low rates. So we're under the impression, and Joshua Brown on CNBC had a very good segment on this yesterday, that kind of with those combined effects, and if you're looking for a crack in the consumer from a credit standpoint, it's not showing there. It's not showing there, right? And so where does the crack lie? And that's in the US. I would say that the Canadian market is a little bit different because of the way that our mortgages are structured. I'd say that we're a little bit more susceptible from a consumer standpoint, but our GDP number in terms of the attribution or the consumer's attribution to GDP is not as significant as the United States, right? Yeah. So the risk from a consumer standpoint, I think, is a little bit overblown because the U.S. consumer is safe. Canadian consumer, from the amount that they're having to refinance with kind of rates of where they are and the mortgage debt that we have, and I would say the housing prices as well, a little bit of a different scenario, right? But the other thing that I really want to focus on is looking at kind of how rates have an effect not on the consumer, but corporations as a whole. And what that inevitably means, if I'm trying to tie this all back together, what it inevitably leads for our fixed income portfolio, Verus strategic fixed income, and ultimately what it looks like for equities as well, right? So overall, 2023, there's been really mixed opinions as of what are rates going to be, right?
Yeah, when are the Feds going to pivot? Are they going to pivot? Are they not going to pivot? Are they going to increase?
Just absolutely every single Fed meeting, they'll release the notes, then they'll do whatever it does, not much volatility during the release, but it is all dependent on the language and verbiage used by Jeremy Powell. That's it.
And do you trust that?
Yeah. Honestly, I can't watch one of those.
Yeah.
Not for a little bit more. But either way, there's mixed opinions as, are we going to have higher rates for longer? There's a lot of people in that camp. But is there an impending cut? Those are people that are more in the bearish camp where they're saying, okay, well, if the recession happens, most likely there's going to be a cut, right? So we can see from the chart here that the US 2-year and the Canadian 2-year have, for all of 2023, been actually quite volatile, bouncing around as we get the meetings, the inflation numbers coming out. So it's been difficult. But I think the moral of the story that you have to understand is, regardless of all the verbiage being used, we're in the bottom of the 9th inning.
Absolutely.
Probably heading into extras, if we haven't already, for the rate hikes.
Yeah. I mean, most of it's in the rear view mirror.
It's in the rear view mirror, right? So the fixed income space had, as from the luncheon and what we have been talking about, had actually its worst drawdown in a century in 2022. So that year, 2022, was the year of duration management. Duration is the interest sensitivity of your bond to how interest rates move. Obviously, interest rates go up, bond prices come down, right? And so that's inevitably what we saw. And so if you did not manage your duration properly in 2022, you went for a very, very hard downfall, right? Yeah. But now that the interest rates are in the bottom of the 9th inning, like we said, almost in extras, the duration component of your portfolio and the sensitivity to interest rates isn't as big of a picture, I believe, anymore. And so what our opinion is, and talking from our fixed income managers that we have, is 2023 is going to be a year of credit risk, credit management, understanding if there are credit events that happen, not necessarily on the consumer side, but the corporate side. How do you mitigate your risk to spreads widening, right? And so if we take a look forward and we say, okay, where are the credit spreads of the Canadian corporate index? Okay, and so what we can see from this chart right now is that Canadian corporates are sitting actually one standard deviation above their average. So they're pricing in some credit risk.
Yep.
Right? And so should they. You have a lot of, obviously, the top 6 banks taking on more loan loss provisions as time comes on here. But still, we have an elevated investment grade credit spread, which I think is pretty accurate based on where rates have been. But the story's a little bit different in the US. So it's actually below the average. So there's kind of not much of that already being anticipated into the spread as it stands. Mm-hmm. So coming full circle and say, okay, well, if the consumer remains strong in the United States, not so much in Canada, okay, that's one portion. But then we take a look at the corporations in Canada. Spreads have already widened a bit, so it's taking into account. But in the US, not so much. The big question becomes, if there is a crack, could it be in the corporate side in the United States? Okay, so this is a really interesting graph that I got from Lysander Canzo, managed the corporate value kind of fixed income high yield space in our alternative strategy. Okay, and so what it shows is essentially the number of kind of high yield corporate issuers that are inevitably going to have to refinance their rock bottom rates that they locked into in 2020, 2021. And a lot of it's coming due in 2024 to 2027. So they're going to have to reprice. They're going to have to go to the street. And if rates remain where they are, if there's a crack out there, that could be a catalyst to kind of a larger credit event. If they can't maintain their debts and they're not able to pay back interest payments, then that's an issue. And defaults could start to widen, and that could be the credit event people are looking for. But then again, it's something that essentially we're taking into account and we have to manage appropriately. So that just goes well into what is the positioning for our Verus strategic fixed income mandate. Kind of 3 key points that I want to hammer down that we've really changed in the beginning of the year here is, 1, we increased our overall credit weighting. Okay. We needed to get higher quality credit in there, and the way that we did that is we stepped into some Canadian government bonds. We just thought now was not kind of the appropriate time to take on undue credit risk, so we did that. We also upticked our duration a touch to essentially provide us insurance against a recession. Okay? The whole point of, obviously, is I've educated a whole bunch of our clients about holding fixed income. Fixed income provides that non-correlated return to equities. Right? Usually, right? And so if we inevitably do get a recession, what will happen is central banks are going to cut. And aggressively, the fixed income space is going to rally quite hard, right? And so that's the whole reason, besides income generation from fixed income, which is now way better than it was a decade before. It provides us recession insurance, right? And so that's why we've upticked the duration a little bit, to where if rates fall and we've stepped more in terms of the duration curve, we're going to get a larger uptick if rates do inevitably fall, and we think they're already at the top. So that could be an uptick for the portfolio. Then the last thing that we have additionally added to is, based on that chart you saw before, Canadian corporates are a little bit more fairly priced. Yep. And a very good, I think, place to be in, and that's where a lot of our investment grade credit lies. We're getting an uptick in yield, and also being monetized for obviously taking a little bit more credit risk, but these are very high quality companies, the banks, the Enbridges, the Teluses of the world, right? So that's the strategic fixed income as a whole and bonds as a whole. And the next thing that we want,
exciting space in the next 6 months.
Yeah, it definitely will be. The performance has been relatively flat for the year. It's been volatile, but it is providing that monthly income, which is obviously very, very important for all of our clients.
Yeah.
Right. So moving on to the equity markets, just providing kind of a quick graph in terms of, okay, well, what happens if interest rate peaks, right? Okay, we understand the fixed income market now, but what does that transpire to in terms of historically the effect on equities, right? And so this graph just shows you the S&P 500 performance 1 year following the last Federal Reserve rate hike. And so I think we had a pause from Jeremy Powell. I'm not too sure if he'll follow through with his words, because I think
you never know. I wouldn't be trusting it.
Yeah, I think the faith of the U.S. Treasury is being under question. But from this, you can get a few really good data points, almost 8 points in time, where you can see on average, going back to 1974, we have 80s, 84, 2000, 2006. The average rate of return over those periods of time on a one-year basis is 13.3%.
Yeah, and that's going to look a lot better than the current GICs that people are flocking to.
Exactly.
And
exactly.
Don't forget, that's the tax advantages.
Tax advantages. You're not getting interest income. It's not being taxed at the top marginal tax bracket. But it's funny when we talk to a lot of clients, I'll take some GIC exposure right now, or money market. It's a cash trap, I believe, at this point in time, where, yes, they're yielding what it is today. If you go into GIC, you're locked in, you miss the opportunity, liquidity is gone. Or you invest in money market, you're earning your 4.5 right now, but we're not making guarantees, but that's not going to be there forever.
Yeah.
Right? And so that 13.3, like you said, Ken, I think is looking a whole lot better.
Yeah.
Just a quick graph. I think everybody's recession obsessed at this point. And I already spoke to Ken about this. People tend to forget we got really negative last year, right? And no, we did not have a recession as illustrated by the gray lines here.
Well, we turned negative in the third and fourth quarter of 2021.
Exactly.
Yeah.
Right? So we ended up getting quite negative, 25.4%, which if you look back historically all the way to 1958, there have been periods of time where you get these large drawdowns, and 25% is pretty much an average compared to, historically speaking, a pretty significant drawdown event. Yes, it's not the 2008, 2000 scenario, and that's, I think, what everybody's inevitably looking for. They're saying if it doesn't fall 50%, it's not a recession.
Yeah.
Right? But historically, you can see that it was deep.
Yeah.
It was deep. And it didn't translate to a recession, and I think a little bit of the data isn't really in line, but you can see historically there have been other points in time where we have gone negative. You take a look at the 1966, 1962, right? Those are periods where we were down northwards of 20, but didn't have a recession, right?
Yeah.
So I think what's transpiring here is, as we step into a new landscape after kind of post-pandemic, post-low interest rates, we're going to get periods of time where I think the cyclicality of business cycles will become a little bit more shorter in nature, as we did see throughout kind of the 50s, 80s, and not the long, I think, run-ups that we inevitably saw through, obviously, the 2000 up until the tech bubble in 2008. So, in essence, be prepared for volatility, but still, I think there's some really good kind of news on the horizon for equity investors, because we think we're just in the beginning here of a new kind of bull market, as it's just starting out right there.
Yeah, and our view is that, yes, we definitely are technically into a new bull market, but we're not naive enough to think that it isn't going to come with volatility. So volatility is there. It's always going to be there because there's so much uncertainty in the world. We're just using volatility as our friend right now.
Exactly. And it is all dependent, as we've taken every single one of our clients through the discretionary move. Risk profiles have changed, so everything is customized to each client. But we do have very, very good diversification across the board, right? So and the ability to be proactive if things change. But that's why I think at this point, we're pretty comfortable with where all of our clients lie at this juncture. And I think in terms of volatility, it becomes difficult to make large changes to your overall portfolio in a time like this. Being caught off guard in terms of a specific conviction could wreak havoc on the overall plan, right? And so we're mindful of that and just kind of sticking to our guns in terms of the asset allocation that we have, and inevitably letting the stories and convictions play through.
Yeah, if you make a bold call, And you're wrong. It's painful. I recently read Thane Stenner from Canaccord. His claim is, he's the an advisor to the ultra rich, and he's moved 50% of everybody's portfolio in cash.
Yeah.
Okay, well, you got to be pretty bearish to do that.
Mm-hmm.
And if you're wrong, yes, you want to preserve capital. That's what everybody wants to do, but a pretty bold statement to go
That's
to
huge,
to go to 50% cash. And if you're wrong, it's painful. I think pretty hard to explain if you're 50% in cash at the beginning of this year on where we are now.
100%. And, at the end of the day, it's time in the market, diversifying yourself properly, and that's what we're here to do. Yeah. Holding high-quality companies, we're going to have noise, we're going to have volatility, but inevitably, if we have the convictions and we make our strategic changes the way that we've been doing, it'll inevitably pay off, and we just have to let time take care of itself.
Yeah.
Right? So just the sector performance, this just really highlights what Ken was already saying. Not going to spend too much time on it, but even in the Canadian landscape and the U.S., it's literally infotech and communications leading the way. Everything else is basically next to nothing. Consumer discretionary up a little bit, but you see energy negative, real estate negative, a whole bunch of those kind of value dividend yielding places.
Financials have underwater, but not by much. But they're a big segment of the marketplace.
Of the market, for sure, right? So it bodes to just looking at kind of how the returns have been distributed from a sector standpoint really kind of alludes to what the performance has been for our mandates as a whole, right? So we've had a rebound in the growth stocks that had pressure in 2022, right? So growth has taken charge, and thus U.S.-focused growth and Verus international growth are up quite significantly. We see U.S.-focused growth northwards, it's up 24, probably up 25% year to date for 2023, and our international portfolio is north of 17, almost at 18%, right? So those did get hit hard in 2022 with the massive interest rate hike cycles, but we were buying some of those things at discounts, right? So that's a space that's taken charge. But then you said, okay, well, what kind of saved you in 2022? Well, it was the value plays. It was the high dividend yielding, cash flow generating businesses that not too many growth prospects ahead of them, but it was the banks, utilities, all that kind of stuff that held in, and why our Canadian mandate held up. We were only down 3% for 2023 or 2022. And our infrastructure mandate, global infrastructure, was actually up 10%, right? That's kind of been flipped this year as growth has taken charge, right? So high income, as is the TSX, not much going on in that space. And there's been obviously a lot of concerns around financials and the SVB and regional banking crisis in the United States. And you can't say that doesn't have an effect on the Canadian market. TD's huge in the US. And
so's Royal, and
having such a large exposure to the Toronto Stock Exchange and financials, you can see why, and even in our mandate as well, it's been flat for the year. And the global infrastructure space as well, relatively flat, slightly negative for the year, was up 10, like I said, last year. But it's those businesses that were in favor last year have quickly changed to not being in favor, right? And so between that, the only other mandate that we have, which is kind of commingled between growth and also value, is our Verus small cap. Okay?
Yeah.
And so, and it's more, I think, like I mentioned earlier, we've seen a widening of breadth in the market as of late. And yes, there's growth elements. There's some value plays in the small cap space, very less researched, well-known companies. And it started to pick up over the last month, and that's why it's up basically 10.6 year to date thus far. And after speaking with Ken Jasudian and having some good calls with him, he believes the margin of safety in his portfolio is one of the best he's seen in his entire career. So pretty convincing stuff that we're seeing on the equity front, and that just really gives us confidence that we have the places that will get us through the tough times, and the diversification necessary into the high generating or the high yielding cash flow generating businesses of Canada, right? But we also have the really growth, high quality elements that are necessary to get you through times like this, right? And so it's that diversification that is very, very much important.
Yeah, and I think it bodes well to the great job you've done on everybody's asset allocation. And as you say, it's flipped. We've gone from, infrastructure and high income 2025 holding up like the Rock of Gibraltar, whereas the tech and the small cap space come under pressure, and now it's flipped.
It's completely
Well,
reversal.
I don't think you and I, we agree that we're not smart enough to figure that out. So we have a very rigid asset allocation model to have
Exactly
exposure into all those areas. And yes, if if it continues to go well in the high income space, we're going to rebalance at the end of the year back to the original asset allocation model.
Exactly, right?
Yeah.
And so the way the equity component still lies at this point in time is we usually have a 40% weight to Canadian equity, 40% weight to U.S. equity, and a 20% weight to international, right? The U.S. component is U.S. focused growth and small cap, and then international is international growth and global infrastructure, right? So at this point in time, if we take a look at what the kind of pure equity portfolio has been, if you were a client that actually has a pure equity mix, if we had that blended model together, we're looking at roughly a return as it stands today of roughly 8 to 9% at this point, right? Which is quite significant considering that, yes, the S&P 500 is up 14, but 97% of the rate of return is 7 stocks.
Yeah.
So not really the S&P 500, it's the mega caps.
Yeah.
And the Toronto Stock Exchange is only up 1.6%. We're already beating the MSCI EFA. So we are diversified, but we know the places where they add value.
Yeah.
Right? And so
it's not about guessing and putting it all into one sector. All we want to do is get on base, hit singles and single after single, and that's what helps derive superior risk-adjusted returns over time.
Exactly. So that pretty much wraps up the market side. Just a couple administrative items for everybody that is watching, kind of things coming down the pipe is we are halfway through the year. Crazy.
Yes.
So we are
review season coming up.
Review season. We're getting back to that. So we are going to be sending out the quarterly performance reports along with the wealth notes as well. And then Ken and myself and I believe Chase will all make a direct phone call to each and every single one of you. Okay. So that was good. Appreciate everybody's time. Thank you guys so much for viewing the video.
You. Really appreciate it.
And we'll definitely be in touch over the next little bit here.
Yeah, we'll talk to you soon. Thanks very much for listening.
Thanks.
Thanks.